Alright, welcome back to the channel. It's me, Adam, and you are watching Unlimited Options Investing. In this video, we're going to be taking a look at the SPY and the NASDAQ, the two most important charts out there right now, and are they flashing warning signs that there are further losses to go throughout the week? This Wednesday, we have CPI data coming out, which is going to have huge implications on the markets. Let's get started. Alrighty, so we're starting off with the S&P 500. Now, I know there are a lot of lines on the screen right now, so just to go through them with you guys. So these two lines over here are indicating an upward channel. We hit that low in the middle of June, made a higher low, and then over here, making higher highs until we broke out of that area. So I'm keeping that channel there for now because there is possibility that we could fall back into it. This horizontal blue line over here is the, let's say, 415 level, which we had previous resistance. We're currently getting rejected from it at the moment. Support back in May, support back in March, as well as an area of consolidation about a year ago in April and in May. We have this downwards channel, which we hit the peak back, I think it was the first trading day of the year. Then in that rip rally back in March into April, we hit that point and we got rejected with a big downward move. So for the time being, it would probably coincide with its $430 area, which also coincides with previous areas of resistance and consolidation, and as well as the 200 simple moving day average. If this rally does have continued more steam, this area 430 would be a huge area. I just don't want to continue adding more blue lines and making it even more messy. We also have the moving averages, the red line being the 20 exponential, the green line being the 50 exponential, and the purple one being the 200 simple moving day average. So yesterday being Monday, we had this red candle over here. We had a rejection. So actually what happened was in the morning time, we actually gapped up and then we found rejection and came right back down to that closing price that we had from last Friday. And it honestly just comes down to Wednesday's CPI data release. And honestly, most people are believing that inflation has peaked. And I think a large part of that is because people have been seeing gas prices been going down over the last month and a half. So I think that might be retail's biggest reasons as to why they believe that. But if CPI does come in worse than expected, if it is above 9% pretty much, in my opinion, I think we're going to go right back down into this channel at the very least. And if we are below 9%, I think that can only bode well for the market. I mean, I don't know if it's going to sell off anyway, or if it will consolidate and potentially even break this 415 level on the S&P 500 or the SPY. When we look at the NASDAQ, this one's showing an even more dramatic shooting star candle, this red candle again. Same idea as the S&P 500. On Monday, we gapped up. We found sellers right away, and then we sold off just below the area that we had closed off on Friday. Similar idea, we had that upward channel. We broke out of it. We have this bigger downtrend that we've been a part of since the beginning of the year, around $330, which also coincides very nicely with these resistances back from April, as well as consolidation areas back in March of this year. And we can see that the NASDAQ has been underperforming the SPY, at least over the last couple of sessions. This red candle over here, the shooting star again, kind of proving the point that this could be a potential warning sign that we might be taking a little bit of a breather after especially rallying over the last month and a half, with technology really leading the way. Looking at the VIX, the volatility index, so I drew this blue line over here that shows that the VIX was swelling ever since October or November of last year, and it seems that we have broken it for the time being. However, the last couple of times we have reached this 19, 20, 21 area, the volatility had spiked dramatically. So we see here April into May, February into March, as well as January into February. So even again, when Omicron first came out in November, we spiked from the 17, 18 area all the way up to 33, and then again, things started to swell up from there. All right, and taking a look at the put-call ratio, so simply put, it's a contrarian kind of indicator. So the more puts that are being open, the higher this reading is going to be, and the more likely that retail is bearish and that Wall Street is selling retail these put options, and vice versa. The lower this number is, the more likely that retail is buying calls, and then Wall Street's going to want to expire those worthless, so the more likely that we could see a short-term topping. And what we'll notice between, let's say, April to the middle of July, this graph shows more toward the upside above 1, whereas it looks like more recently we have been more below 1 ever since, let's say, the middle or beginning of July. reaching 0.66 a couple of times, even in the beginning of yesterday, and then seeing that number go up. So I know it's a very messy kind of looking indicator, but it's more so a supplemental indicator, what smart money and dumb money are both doing. The 2-year and the 10-year yields are going to be very, very much affected by Wednesday's report. Right now they are very much inverted at, let's say, 0.5% or 50 basis points, and honestly, depending on what the CPI will look like on Wednesday, if we do see a spike, that will very more likely than anything mean that the markets will go down very dramatically. However, if inflation isn't so bad, perhaps the 2-year could stabilize or even go down from here, which would be positive for the markets for the short to medium term. But in terms of a recession and all that talk, the longer that the 2-year and the 10-year are inverted, and the bigger the difference and the bigger the gap between them, the worse that a potential recession could be moving down the line. Likewise, if we take a look at XLY, this is consumer discretionary, made up, I believe, like 40 or 50% of Amazon and Tesla. We see a similar shooting star candle, and we can even see that exacerbated if we look at XLY relative to XLP being consumer staples. So we're looking at names like Walmart, Johnson & Johnson, Procter & Gamble, names that no matter what happens in the economy, we still need to purchase these kind of items. We're still above that 2.2 area, so I'm going to be interested to see if we're able to hold. If not, those moving averages are around 2.1. Also looking at XLK, this is the information technology fund, so we're looking at Apple, Microsoft, Nvidia. Again, a red candle, and is this a sign for things to come to go back to their moving averages? When we look at XLK relative to RSP, which is the equally weighted S&P 500, to show how XLK or information technology is doing relative to other sectors, we're still finding some kind of support around the top of that previous upward channel, as well as hovering around that 200 simple moving day average. So depending on how technology does over the next couple of days, either we're going to hold on to this area of support, or if we see more weakness in the markets, go back into this channel over here. Alright, and that's it for my video. Thank you very much for watching. Don't forget to subscribe, hit that like button, and I will see you guys in the next video.